Hi guys, welcome back. I have invested in the S&P 500 every single month for years now. It was my go-to, my safety net, my set it and forget it strategy. Why? Because it's cheap, it's strong, and it's what everyone recommended. But the truth is, my core ETF was giving me a dangerously narrow slice of the market. 100% US exposure, no small or mid caps, no emerging markets. And even though my strategy is to invest in high quality global companies for the long term, my ETF wasn't matching that vision at all. So I started to dig deep. And I found 5 global ETFs, some obvious and some completely under the radar, and compared them head to head. And in this video, I will show you why I'm leaving the S&P 500, which ETFs I considered as replacements, and the one I ultimately picked and that most people probably have not heard of before. And no, it's not just about performance. It's about strategy, fit, and creating a portfolio positioned for long-term success, not short-term trends. And if you're new here, my name is Florian. Thank you for joining me today. So, I have invested in the S&P 500 every single month since even before I started my dividend growth portfolio for 2 simple reasons. First, US stocks have outperformed the rest of the world for more than a decade, and I wanted to participate in this trend. And second, the fees for the S&P 500 ETFs were the lowest I could find when I initially started my savings plan. Those are 2 reasons, but admittedly, probably not the best ones. So recently, as I have also mentioned in my portfolio updates, I started to wonder if the S&P is really the best ETF for me and aligns with my goals. Because a good past performance alone doesn't necessarily mean that it's also a good fit, and also doesn't mean that it will perform well in the future. And after doing some research, I actually don't believe so anymore. The good fit part, not the perform well part. I will explain why I think that in a bit, but in order to understand my reasoning, let me first quickly explain my portfolio strategy so that you know from which angle I'm viewing this. The strategy for this portfolio is to build a diversified portfolio that focuses on high quality companies with a moat. To find these companies, I am not exclusively focusing on high growth, but also other fundamental metrics like a strong balance sheet, high profitability, and good cash flows. I also put some emphasis on stocks that are paying and growing a dividend, but I'm not only focusing on dividend stocks. The current dividend yield also doesn't play too big of a role for me. And the time horizon for my investments is 5 to 10 years. So I'll only invest in companies that I believe can keep performing well over longer time periods. Currently, my portfolio consists of 19 hand-picked individual stocks and 3 ETFs. And the only ETF I contribute to through a regular savings plan is the S&P 500. And while one of these 3 ETFs, the iShares Digital Securities ETF, is a very focused specialty ETF that could almost be viewed as an individual stock for the sake of this portfolio, the S&P 500 together with the MSCI Emerging Market are meant as kind of my core investments. Now, with my strategy being to build a diversified portfolio that can perform well over longer time periods, the intention of my ETFs, at least the broad market ones, is to build a strong and dependable backbone for my portfolio. And with this, you can probably already guess what my main issue with the S&P 500 is. Because as the fact sheet of the SPY, most likely the best known ETF on the S&P 500 index states, it tracks diversified large caps from the US across all 11 gig sectors. And while it has diversified in its description, I would argue that an ETF that includes only large caps and only US stocks is hardly diversified. And to alleviate at least the US focus a little bit, I already added the emerging market ETF to my portfolio. But it doesn't help at all for small or mid caps. And now I am also in the predicament of how to balance these 2 against each other. Should I put a larger focus on the US stocks because they have the momentum on their side? Or should I rather focus a bit more on emerging markets because their valuation is cheaper? Or should I just invest 50-50 and be done with it? And on top of all that, with this setup, I am also pretty much ignoring all European stocks from the get-go, which is definitely not my intention. So there are a bunch of problems with my ETFs right now. And in order to better diversify my portfolio, not only geography-wise, but also market cap-wise, I would need at least 1 or 2 additional ETFs. But I would like to keep the ETF portion of my portfolio as simple and lean as possible. Now, I know that the US and the S&P 500 with it have outperformed most other indices like the MSCI World in more than a decade now. And this was one of the major reasons I decided for it in the first place. But this outperformance has historically been cyclical, as this data from Bloomberg shows. Every time the blue graph here is above the 0% line, US stocks have outperformed compared to international ones, and every time it is below this line, international stocks did do better compared to US ones. So there are long periods of outperformance from international stocks compared to US stocks, like in the early 2000s, 1980s or also 1970s. And as the book Triumph of the Optimists shows very nicely, countries and their markets tend to rise and fall over time. For example, the German market in 1900 made around 30% of the global markets. Today it is only 3%. And even the US market, that is by far the biggest now, had its ups and downs and did decline by 50% in the 1990s. Yes, it has been the strongest for the last 14 years, and yes, there is still a lot that speaks for the US market. But nobody knows what will happen, especially over longer time periods. One of the most significant factors in the US outperformance over the last years has actually been the strengthening of the dollar compared to pretty much every other currency in the world. In 2008, for example, you needed $1.60 to buy a euro. But recently, they have almost traded 1-to-1. So the euro lost 38% of its value compared to the dollar. And we have similar stories for the pound, the Canadian dollar, Indian rupee or Japanese yen. But this doesn't mean that companies from outside the US are not growing. It's simply that they are not as profitable in US dollars as they were when the dollar was weaker. But the US strategy concerning the dollar is not so clear anymore. And Trump's tariff policy also runs the risk of undermining the dominance of the dollar. But this is not the topic of today's video. And don't get me wrong, I am not trying to avoid the US market and the dollar per se. When I look at my individual stocks only, I already have around 65% of my allocation in US stocks. But this makes it even more important in my eyes to have something more diversified as a core ETF. So I started to research globally diversified ETFs. Of course, the first thing I found were the two most obvious ones. But I also found one that is not so well known and two that are pretty uncommon but that I actually like the best. These two obvious ones are, of course, the MSCI World and the FTSE All-World, which are both two absolute investor favorites. Now, the thing is, I don't like the MSCI World very much. And when we look at Just ETF's list of the top all-world ETFs, we also can't find the MSCI World here. The reason for this is very simple. As MSCI states in the fact sheet for the index, its goal is to track large and mid-cap companies from 23 developed countries. But it also leaves out small caps and emerging countries completely. That also includes countries like China or India. And even mid-caps are very underweight in this index. That is no problem for people who are okay with taking on several ETFs. But again, I'd like to simplify the ETF portion of my portfolio as much as possible, and I am looking for a real diversified ETF. And MSCI actually also has an ETF for this. It's called the MSCI All Country Worlds. This basically combines the MSCI World with the MSCI Emerging Market to cover 85% of the global investable market. It includes around 2,500 companies today from around 47 countries. But it is still limited mostly to large caps with a couple of mid caps thrown in. The FTSE All-World Index goes even a step further. Unfortunately, it also only includes large and mid caps from around the world, but the coverage of the global market is 90%. So it covers 5% more than the MSCI All Country Worlds. Both of them still consists of 90% developed countries and only 10% emerging countries. This is definitely better than 100% developed countries, but if possible, I'd like to have an even higher portion of emerging countries, let's say around 15 to 20%. And when we compare the index performance of these three and the S&P 500, the total performance that includes dividend but excludes any potential fees, we see that with a one-time investment, the S&P 500 as comparison did perform the best in the last 10 years. But all the other ones are pretty close together. The MSCI World is actually a tiny bit ahead of the other two, but it is not so much that it will influence my investment decision. But wait! I mentioned that I also found two other ones that are not so well known and that I like even better. And the first one of these two is indeed a pretty special one. It is the MSCI World Momentum Index. This is based on the MSCI World and applies an additional momentum strategy that is designed to put an emphasis on stocks with high price momentum. I recently read and learned a lot about the momentum factors in my studies for my upcoming quant rating model. And I think that there are still many misconceptions about this out there. But by now, many papers and studies have basically proven the effectiveness of the momentum factor and the momentum strategy. And in the performance graph in the fact sheet that backtests the index for 15 years until 2010, it also shows that when applied to the MSCI World, it can indeed outperform the core index. But this also comes with a drawback, because it also introduces a higher volatility and therefore risk to the index. For me as a long-term investor with a long time frame, this wouldn't be a big issue though. With my individual stocks, I'm also already used to drawbacks, so I won't get too nervous when the index crashes. But because it just takes the stocks of the MSCI World and sorts them even further, it only includes 351 stocks compared to the 1,325 of the core index. Now, you might think that this reduces diversification and increases the unsystematic risk. But actually the opposite is true. Because the unsystematic risk not only depends on the amount of stocks, but also how they are distributed across countries, sectors and market caps. If you, for example, own 100 stocks, but all of them are from the US tech sector, that is not a real diversification. And when we compare the distribution from the MSCI World against the momentum, we see that the momentum ETF actually has a lower US portion and a higher other portion. So individual countries are more equally weighted. The sector weights are also pretty different from the core ETF, but in this case there is no much more diversification. It's just different. One thing we should also take into account here is that the momentum factor requires regular rebalancing. So it gets rid of stocks where the momentum ran out and buys stocks where it is picking up. And because of this, I would expect that the fluctuation and changes here are also higher compared to the core MSCI World. But what I'm still missing are emerging markets and small cap stocks. I would much prefer a similar index based on the MSCI All Country World, and this does exist. I just couldn't find any ETFs based on this index at all, and my broker also doesn't offer any. So this is unfortunately not an option yet. But it brings me to the last ETF I found. This is also the newest one and was just set up in 2021. It is the Vanguard ESG Global All Cap ETF. And if you're wondering, no, it is not available in a non-ESG version because it excludes certain industries like adult entertainment, weapons or non-renewable energy providers. Instead, as the name implies, they include the whole investable universe market cap-wise. Large caps still make up 70%, but that is 30% less than all our other ETFs. And it also includes emerging markets with a bit under 10% weight. So this one is the most diversified of all of them and comes closest to what I'm looking for. Unfortunately, it has one very specific problem for me. But before we go there and I show you my final decision, let's also compare all 5 of these ETFs directly against each other. And guys, if you like the video so far, please subscribe to the channel so you don't miss the next one. I know that it's a bit annoying to ask this, but it really does make a difference. As a small thank you, I promise you to read and reply to all of your comments. And now, let's compare our 5 ETFs. First of all, for most of these indices, multiple ETFs from different providers are available. My selection criteria here are a decent fund size and a total expense ratio or TER that is as low as possible. The costs of an ETF is actually the biggest impact choice we as investors have besides the choice of the index, of course. So don't sweat too much if you don't find exactly the same ETFs from the same providers as I do here. Just look for a cheap one that has a decent fund size so it doesn't run the risk of being liquidated. I also only choose accumulating ETFs here so that my dividends are reinvested automatically and I don't have to pay taxes on them first. But this is mostly up to your preference. All of these ETFs are also available in a distributing version. To compare the performance of all 5 ETFs, I use TradingView because the time frame in just ETF is always limited to the inception data of the newest ETF. And because the global all caps is only available since 2021, this is a bit short for my taste. Still, in this time frame, the S&P 500 here in the candle chart has again performed the best, while the global all cap in cyan actually had the worst performance. The FTSE All World in red and the MSCI All Country World in green are basically on par, while the MSCI Core ETF in purple had the best performance and did even beat the MSCI World Momentum by 5%. But when we zoom out a bit to the next inception date, which was the end of 2014 for the Momentum ETF, the picture changes a bit. The S&P 500 could still handily beat the rest, but the MSCI World Momentum ETF comes in as close second. The regular MSCI World is still placed in third place, but the performance difference to the top two is much bigger than the 20% difference to the MSCI All Country World and the FTSE All World that are again pretty close to each other. What is also pretty close are the top 10 holdings in each of these ETFs. Only the weight of them is a bit different, but this is to be expected with the different holding counts. What I found a bit surprising though is that the concentration of the top 10 companies in the global all cap ETF is actually higher than in both of our all world ETFs, even though its holding count is almost double that of all the other ETFs. One last thing I want to note before I explain my decision is that the MSCI World Momentum ETF and the Vanguard Global All Caps have almost double the expenses than all the other ETFs. The cheapest of the bunch is the standard MSCI World Core ETF with a very low 0.06 TER. So now that I have all the necessary information, it just leaves me with the decision of which ETF fits best into my portfolio. And I'm not gonna lie, I found the decision to be a pretty tough one. So let's use the elimination strategy to make it a bit easier. First, I already mentioned that I don't like the MSCI World too much because of its low diversification. Yes, it is still better than the S&P 500, but it still doesn't include small caps and emerging countries. So let's remove it from my selection. Then we have the two very similar, FTSE All World and MSCI All Country World. Both of them have basically the same strategy and their performance is also pretty much the same over different time frames. But the MSCI All Country World has a slightly lower TER while also having a higher fund size. So from these two, I'd prefer the MSCI one over the FTSE. So let's also remove the FTSE, which leaves only three. The MSCI All Country World, the MSCI World Momentum and the Vanguard Global All Cap ETF. From these three, I find the MSCI Momentum ETF pretty interesting. As I said, the momentum factor is proven now and the ETF could also outperform the other global ones, especially over longer times. But because it is still based on the MSCI World, it also includes neither small caps nor emerging countries. If an ETF based on the All Country World Momentum Index would be available, I'd probably take this one. But even if the past performance of this one was pretty good, I'll have to keep my strategy in mind and still skip it because it just leaves out too many factors. And to make it short, even though the performance of the Global All Cap Index wasn't too good since its inception, I believe that this was due to the underperformance of small caps compared to large caps in the last 5 years, especially on an international level. So the one I decided for in the end and the one I will switch my monthly savings plan to is the Vanguard ESG Global All Cap ETF. Now, I mentioned that I do have a very specific problem with that. And that is that my current broker Consors Bank doesn't have a free savings plan for this available. So it would get rather expensive to set it up with them. But I either way wanted to try Scalable Capital as a broker for some time now, where this is free. So now is the time to set up an account there and try it out. And this is not a sponsored video, this is my own decision. I am not getting any money for saying this. Now, let's just hope that my new ETF from here on out will have a better performance compared to the last 5 years. But this is just my opinion. Which of these 5 ETFs do you like best and why? I'd be really interested to hear your thoughts down in the comments below. And if after all this ETF talk, you are now interested in a 8% dividend paying renewable energy fund Green Code UK Wind, this video here will be exactly the right one for you. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.